Hey, thank you, Frank, for the introduction, and thank you all for joining us today. I wanted to start by giving a bit of an introduction for why IFPRI and PIM are studying innovations to improve agriculture insurance. So millions of smallholder farmers rely on crop production for their livelihoods, which makes them vulnerable to unpredictable weather. And a large body of literature shows that when households are trying to cope with income losses from catastrophic weather events damaging their crops, they resort to coping strategies that have long-term consequences. They might, for instance, reduce food consumption, which leads to malnutrition, or invest less in education. Because they are faced with so much uncertainty, farming households also underinvest in profitable agriculture activities to reduce their vulnerability. But this lowers their incomes, and as such, it is difficult to climb out of poverty. And the publication referenced in this slide shows that global warming will only make this worse. Under different models for climate change, the developing world will become increasingly vulnerable to production risks and food insecurity. So in this context, agriculture insurance can help reduce smallholder farmers' vulnerability and unlock investments in agriculture. But insurance also faces a number of challenges. First, the administrative costs of operating an insurance program, and in particular the costs per insurance transaction, are high relative to the amounts that smallholder farmers are trying to insure. And even if we can reduce those type of costs, for instance, by using mobile technology in the enrollment process and using mobile money, we are still faced with the issue that the insurer cannot observe everything that the insured farmer knows and does. And this can give rise to adverse selection, meaning that high-risk farmers are more likely to enroll into the scheme, and to moral hazard, which means that insured farmers have less of an incentive to prevent crop damage. This increases expected insurance payouts and hence insurance premiums. Index-based insurance was designed to overcome these challenges by triggering payouts on the basis of an objective external index that the farmer cannot control or manipulate. For instance, the weather, vegetation, or average yields in the area. But also index-based insurance has a number of challenges. And a really important one is basis risk, which means that the index that is used to determine how much a farmer should be paid out does not capture well the farmer's actual conditions on the ground. And related to this is also a lack of trust and understanding that farmers have in the conditions under which the product should pay out. So in the next 30 minutes, Patrick and I will be presenting a number of innovations that IFPRI has been studying on, working on in the past few years to address some of these challenges associated with index insurance. First, I will speak about the use of smartphone pictures for crop loss monitoring. And after that, Patrick will speak about adjusting index insurance to make it more compatible with climate-smart agricultural practices and technologies. The first innovation that I've been studying together with a group of colleagues is a new concept that we call picture-based insurance, in which farmers can send in pictures of their insured fields for claim settlement. The idea of picture-based insurance is simple. To enroll, farmers download a smartphone app to their phones and register. In the smartphone app, they take an initial picture of their field to lock in the field they want to enroll for claim settlement, and then they submit this picture to the insurer. And throughout the crop season, from sowing to harvest, the farmer takes regular follow-up pictures of the crop within the smartphone app. And together with other sources of information, such as information from satellite imagery and weather data, these pictures are processed and analyzed to assess the extent of damage in order to determine the amount that a farmer should be paid out. Initially, the images in our evaluations are reviewed by experts, but as more data becomes available, one can imagine that models predicting damage based on the images, for instance through machine learning, will become more accurate. So in the future, we are hoping to automate this process, which is of course important to scale up this approach. The smartphone app that we have is designed to be as tamper-proof as possible, and all pictures are geotagged and time-stamped, and farmers cannot access pictures from the gallery to edit the images and, for instance, apply a drought filter. This also applies to an initial picture that farmers take at the time of enrollment, which is saved within the app. And then every time that they take a follow-up picture, they will see the initial picture as a transparent image in the screen, overlay this with what they see in their field in order to make sure that they take follow-up pictures of the exact same location as the initial picture. Now, the idea behind these standardized procedures is that it helps documenting not only whether the crop is damaged, but also whether the crop was growing well before the damage occurred. And in this way, the pictures help overcome problems of asymmetric information between the insurer and the insured, because now the insurer has eyes on the ground. To test this concept, we conducted a formative evaluation in Haryana and Punjab, 2 states in northwestern India. And here we focused on wheat because this is what most farmers grow in the winter season. Farmers in the study received an insurance product for 1 acre of their wheat, conditional on taking pictures showing the growth of their wheat, following the standardized procedures that I just described. The product had both a weather index component, and it also provided coverage for any damage from natural causes visible in the stream of pictures. Now, in what follows, I will present 4 key results from this formative evaluation. A first question that we asked in the study was whether it is possible for agronomists to assess losses from the stream of pictures and whether their loss assessments help reduce basis risk compared to the weather index-based component. To address this question, we compared average yields for farmers without and with insurance payouts, and we would want to see, of course, lower yields among farmers with insurance payouts. But that's not what we found for the weather index-based component. Average yields for farmers without a payout and for farmers with payout were almost the same. This means that there were farmers with payouts who did not suffer severe damage, while there were also farmers who did suffer damage but not receiving a payout. And that is what we mean by basis risk. For the picture-based loss assessments, we found much better results. Here we measured significantly lower yields for fields that agronomists had classified as having more damage. And this means that farmers with higher insurance payouts also were the farmers with more damage, which is indicative of lower basis risk. And that is something that could potentially really help improve demand and the impacts of insurance products. And we also explored, together with Koen Hufkens from Ghent University, whether it is possible to use the pictures for growth stage monitoring. And what we found is that indeed, the greenness of the pictures, which we show here on the vertical axis, is closely associated with crop growth stages. In the tillering phase, when soil is still visible, greenness is slowly increasing. Then when the greenness passes a first threshold, the wheat has entered the stem extension phase. And finally, once the greenness starts declining and drops below a second threshold, the crop has started heading and ripening. Now, this could be potentially helpful for insurance policies that are trying to target specific growth stages during which the crop is actually at risk, which in our case was mostly the heading and ripening phase in the case of India in the Northwest. And so what an insurer could do in this example is to use the smartphone pictures to monitor growth stages and to, instead of cover farmers during the entire period in which farmers might be at risk, in this case from early February to mid-April, to actually adjust the period to when a specific farmer is at risk. For instance, farmers who enter the heading and ripening phase earlier, starting in early February to end of March, and for others, this could be early March to mid-April. Now, this would, for every insured farmer, it would reduce the coverage period, the length of the coverage period, and that could help reduce insurance premiums and also reduce basis risk. Now, it's worth noting here also that if we were using satellite imagery and vegetation indices derived from satellite imagery, we were unable to predict the transition into different growth stages as well. And so that indicates that the pictures could really provide extra value. So our findings combined so far indicate that picture-based loss monitoring can, one, help reduce basis risk, and that the pictures can potentially also be used to monitor crop growth stages, which can help further reduce the cost of providing weather index-based insurance. Then as a next question, we look into the economic viability of picture-based loss monitoring. And as a start, we compare demand for different types of insurance with fairly comparable premium rates. In this figure, we plot the demand for insurance as a function of the insurance premium. When premiums would be 5% of the sum insured, which is the rate that farmers pay for commercial crops under India's National Crop Insurance Scheme, we see significantly higher demand for picture-based insurance, shown by the green line, than for weather index-based insurance, which we are showing as the orange line. And demand is largest for the combined product, offering both types of coverage, without really significantly increasing costs. This suggests that farmers are willing to pay for improved insurance coverage that is also more tangible for them because they build a track record of their damage using the smartphone pictures. A fourth issue that we looked into is whether the use of pictures induces farmers to start tampering with pictures and whether it creates moral hazard. Eliminating this is also important from a viability point of view because tampering or moral hazard could really drive up insurance premiums. So for that, to test whether the system of standardized procedures put in place was sufficient to eliminate tampering and moral hazard, we used an experiment in which we randomized whether farmers were offered the weather index-based component only, or that same product with weather index-based insurance, but with coverage for visible damage in their picture, so more picture-based insurance. If this creates moral hazard, picture-based insurance, we would expect lower yields or more damage on the fields. Of that, we actually do not find evidence. Also interesting is that we did not find an effect of picture-based insurance coverage on the use of various inputs, fertilizers, pesticides, labor, and this suggests to us that at least in this formative evaluation, insurance coverage did not make farmers negligent of their plots or stop adopting any risk preventive measures. Of course, this is something to keep monitoring, and testing whether moral hazard remained limited in our study because of the standardized procedures that we put in place, or because farmers still have to learn how exactly picture-based loss monitoring would work and that they could play the system. But overall, these are really encouraging results, showing both the technical feasibility, but also the potential economic viability of this approach. Now, in terms of next steps, we are working with an insurance company in India, HDFC ERGO, to take this a step further. We have worked with HDFC from the very start of this project, with HDFC pricing and underwriting the risk of using picture-based loss monitoring. And they're very interested in using this approach on a larger scale in their existing insurance products. We also have concrete plans on working with the private insurance sector in Kenya on introducing picture-based loss monitoring in their insurance products. We also are working to automate image processing and damage detection using these images, but this requires large data sets for training and validation and past images. Now, to mobilize these data, one can already work with the approach that we have developed now, with experts visually inspecting the images at a fraction of the cost, at a fraction of what it would cost to send an insurance adjuster into the field to verify claims. A third aspect that is important is evaluating the impacts of this insurance approach. And for that, we are focusing on high value but risky horticultural crops. In doing so, we are paying special attention to inclusiveness, in particular to issues around the use of technology for potential beneficiaries that may not be as familiar with smartphones, for instance, women and the elderly. And then finally, we are looking into the enabling environment for this type of insurance to work. For instance, whether there are complementarities with agro-advisory services, on which we have a set of exciting results that I'm happy to speak more on if there is more time during the Q&A. One could also think of bundling with climate smart technologies, on which Patrick will say more in a bit. Now with that, I'd like to conclude with how we envision our findings being used. We don't see picture-based insurance as a standalone product, but rather that it is integrated in existing insurance approaches, index-based insurance, to monitor fields and cover risks that the standard index did not capture, like a fail-safe trigger. This could help reduce basis risk, improve farmer engagement in the process, and make the product more tangible for farmers. So with that, I'd like to hand it over to Patrick. Thank you.
Great. Took me a while there to figure out how to unmute myself.
Okay,
great. Thank you, Berber. So I'm going to be discussing some preliminary results from a randomized controlled trial that I've been conducting with some colleagues at IFPRI to evaluate, as Berber mentioned, a comprehensive risk management product that bundles together climate-smart agricultural technologies with an index insurance product. Now, we conducted this in the state of Odisha, which is in eastern India along the Bay of Bengal. Odisha is traditionally known as the disaster hub of India. It's been prone to various natural hazards over the years. It's historically been known particularly for the impacts of cyclones because it does lie on the coast. But importantly, there are many parts of Odisha that have been prone to droughts historically, and particularly the area that we have been focusing on is an area that has historically been very drought prone. It's an area that relies primarily on rain-fed rice production during the monsoon season as its primary agricultural activity. And because the crop is rain-fed, and because of the vagaries of the annual monsoon and the increasing uncertainty with the arrival and departure of the monsoon, the farm households in these areas are especially susceptible to drought. When we think about droughts and the effects of droughts on agriculture, there are really two types of impacts that droughts inflict. The ex-post impacts are very obvious and tangible. These result from the drought itself and manifest themselves in production losses for the affected crops and livestock, natural resource depletion, and a depletion of household assets as the households then attempt to smooth the consumption in the midst of these production losses that they're experiencing from the droughts. Importantly, however, there are also what are known as ex-ante impacts that arise simply due to the nature of drought risks. So not knowing when or how severe a drought could potentially occur leads farmers to act in an overly conservative fashion, very similar to one of the earlier slides that Berber was showing. And so farmers forego productive investments that could increase their expected productivity in attempts to reduce the variance of their productivity or their exposure to risk. So this may ultimately be a less risky path for farmers to take, but it also diminishes their long-run productivity and growth trajectory, and potentially ensnares them in a pernicious poverty trap. Agricultural insurance offers farmers a means with transferring risk, and in theory could alleviate both the ex-ante and the ex-post impacts of droughts. Unfortunately, as we've seen in numerous examples over the years, many agricultural insurance programs have had limited success, to put it mildly, and this is for a number of reasons, many of which Berber has mentioned previously. One particular approach that have arisen with previous programs is to bundle agricultural insurance with climate-smart agricultural technologies and practices, or CSA for short. So why should we consider bundling CSA with an insurance component? The logic behind this is seen in this graphic here. Many CSA technologies perform better than conventional technologies under increasing drought intensities, which in turn implies that there is less drought risk on the intensity spectrum that would need to be insured against. This reality in turn implies that the actuarially fair cost of the complementary insurance needed to cover the remaining drought intensities on the spectrum is less than it would be for an insurance component designed to pair with the conventional crop varieties. The specific CSA technology that was used in the bundled product in our research was a drought-tolerant rice variety. In India, it's marketed as Sabaki Dan, but it has a very similar genetic lineage to several other varieties that are being promoted throughout South Asia, including Viridan 56 in Bangladesh or Sukhadan 1 in Nepal. So when I say they have similar genetic lineages, they share at least one of the same parental lines as these other varieties. So Sabagidan has a couple of features that make it advantageous for cultivation in drought-prone conditions. First, it's a short duration variety, considerably shorter than many of the other prominent mega varieties that are grown in eastern India. And because of its short duration, that allows it to escape prolonged dry spells that occur at either the beginning or the end of the monsoon season. Secondly, by its genetic features, again, derived from its parental lines, it is able to withstand prolonged periods without rainfall that other commonly grown monsoon rice varieties would not be able to withstand. It's also a relatively high-yielding variety, even during normal conditions with either irrigation or adequate rainfall. So there's no yield penalty for growing this drought-tolerant variety during normal conditions. But where it really shows its benefits is during periods of drought stress, in which it overperforms by a fairly large degree many of these other commonly grown varieties. The weather index component that was bundled together with Sabagi Dan was calibrated to begin paying off when the drought severity reached approximately what would be deemed as severe levels. Now, defining a drought as severe is a little bit of art and a little bit of science. I mean, we did look at historical data to see what sorts of droughts had varying degrees of impacts. We also looked at the literature to see how severe droughts were defined. And again, as I mentioned, it requires a little bit of nuance in order to really understand what where the fine line is between a moderate or a severe or an extreme drought. Suffice it to say, we ballparked it and structured the insurance to begin paying out when the drought severity got to what might be deemed as severe levels. And the payoffs that we built into the insurance component were structured to be roughly equivalent to the value of lost production that farmers might experience during these severe droughts. The coverage area that we allocated for each unit of insurance was 1/10 of an acre. In Odisha, they refer to these as 1/100th of an acre is equal to a decimal, so this was equal to 10 decimals. And given the relatively small farm sizes for the farmers that we were dealing with, this wasn't a minute portion of their total land holding. This was a non-trivial amount of their land holding. The bundled product was marketed to farmers in our treatment villages. Again, this is a randomized controlled trial, so we have treatment and controlled villages. It was marketed to the farmers in our treatment villages through a series of information sessions that were organized by our implementing partner. But since this was a 2-year randomized evaluation, we were able to vary the pricing structure from year to year to test A, how sensitive farmers were to the product prices, and then B, how the framing of the price chain affected farmers' uptake rates. And I'll get a little bit into greater detail at what I mean by framing of the price change. In the first year of the study, we saw really high uptake, or what we thought was considerably high uptake. About 59% of eligible farmers purchased insurance. And again, we thought this was particularly high given that it was priced close to actuarially fair. So again, contrary to the long-held notion that farmers wouldn't be willing to pay for insurance unless it was discounted dramatically. But because this was the first year of our study, and for many of the farmers, this was their first exposure to agricultural insurance, there was a little bit of tepidity in that most farmers only purchased a relatively low coverage level. In the second year, the uptake levels dropped quite a bit, down to only about 36%. The price for the product in the second year was actually above the actuarially fair price. So again, we're trying to move closer to what might be expected from a commercial product offering rather than an offering from a research organization or an NGO. So in many ways, this drop-off reflects farmers' sensitivity to the increase in price from year to year. In the second year, we also attempted to isolate the effect of framing the price change, how that affected the level of uptake. So what I mean by framing of the price change, we randomly allocated a quote-unquote artificial subsidy. So in essence, across the board, the effective price that the farmers were paying was essentially the same within district. We allowed for prices to vary across district to reflect differing degrees of drought risk exposure and different productivity levels. But within districts, the prices were the same. But certain villages were randomly selected to be informed that the price that was being offered was a quote-unquote subsidized price, even though the fact the price was actually the same as what other villages in that district would be receiving. It was marketed as a subsidized price to again see if farmers would respond differently to something that was being offered as subsidized rather as a take it or leave it offering. Interestingly, there was essentially no difference in the uptake rates between the group that received the quote-unquote subsidized product versus those that didn't. And I'll come back to this in just a moment. When we consider the patterns of uptake across the 2 years of the experiment, we were encouraged that roughly a quarter of our sample purchased the product in both years. What is discouraging, however, is that about 30% of the farmers in our sample didn't purchase the product in either year, and an additional 33% dropped out of the market after the first year and were not replenished by a proportional measure of farmers who entered the market in year 2 after having sat out of the market in year 1. So our next task was to then try and figure out what explains these uptake patterns. Since the nature of these decisions changed from one year to the next based on the changes in the pricing structure, and at least in the second year, the experiences that they had in that first year, we wanted to look at the decisions separately for year 1 and year 2 of the experiment. To do so, we considered the production decision, or the purchase decision in each year to be a sequential process in which first the farmers decided whether or not to purchase to participate in the product market, and then only having arrived at an affirmative on this first stage, they then decide how intensely they want to participate. That is, they decide how many units of the drought-tolerant index insurance product to purchase. Now, there are a couple of factors that we might expect to influence uptake across these 2 years. Many of the factors we would expect to be the same, but one thing that we did expect is that in year 2, we expected farmers to have learned from their own experiences in year 1, and then also potentially learning from their neighbors' experiences in year 1, and particularly learning from their experiences in purchasing, and then if they also experienced a drought, that we thought should have some influence as to whether or not they would be interested in purchasing the product in year 2. Now, I should mention that out of the 6 blocks in which we worked, so we worked in 3 districts in Odisha, within each of those districts 2 blocks, which are sub-district administrative units. 3 out of those 6 blocks experienced a drought during the first year based on the rainfall measurements that we collected. So again, this was a rainfall-based index insurance. So when we looked at the factors that were affecting farmers' decisions to participate in the market, we found that as expected, price was an important factor, but it was really only important in terms of whether or not they made that binary decision to enter into the market. It didn't have any effect on how intensely they participated in the market. In other words, it didn't really affect how many units of insurance, how many units of the DTWII product they purchased. Now, part of that could be a spurious non-result because we exogenously limited the number of units that could be purchased. So that's potentially why we don't see much of an effect on the intensity of participation. But we do find fairly strong evidence that peer effects crowded in participation. So if a farmer in a particular village had several other farmers in his village who were also participating in the product market, that farmer was also more likely to participate. We found that risk aversion didn't have any effect on participation, but did tend to mute the intensity of participation. We thought this was a little bit counterintuitive, since risk-averse farmers should in fact benefit more from the risk management than less risk-averse farmers. But we came to the realization that because this is a new product, this effect could arise from farmers simply being leery of an unfamiliar product. And additionally, since the weather index component does retain some element of basis risk, this could simply reflect farmers' aversion to uninsured basis risk events. When we looked at year 2, the results suggested strongly that own experience is in year 1 matter a great deal. So for example, if farmers purchased the product in year 1 and subsequently experienced a drought as determined by our index, which then implies that they received an insurance payout, they were more likely to participate in year 2 and also to participate more intensely. The experience of one's neighbors, on the other hand, didn't have an effect. But this is perhaps due to the fact that it's difficult to observe neighbors' experiences, or at least difficult to observe neighbors' experiences with the insurance component of the product. And since the insurance component of the product contributes the greatest portion to the overall price of the product, it stands to reason that farmers would need to somehow observe really compelling evidence from their neighbors to move the needle, and evidently they didn't see that compelling evidence. But as in year 1, we did see that contemporaneous peer effects crowded in participation, and in this case also the intensity of participation. Now again, because the purchasing decisions were made during these information sessions, which were essentially group meetings, it's very likely that there was a wanting to be seen type of effect going on. Farmers didn't want to be seen as not being part of the in crowd, and so that might be explaining why we see this crowding in effect from peers. As I previously mentioned, there was not this effect of framing a price change as a subsidy on increasing demand. Now, I think this is a really interesting result because the argument is often made, and I've been guilty of making it myself, that subsidies are generally required to sustain insurance programs, at least in the early years of the program, as farmers learn more about the way that the insurance product worked. They learn more about probabilities and magnitudes of potential losses. There's also this prevailing mentality in South Asia that farmers suffer from subsidy syndrome and won't do anything that is socially optimal unless the government steps in and provides them with some incentive to do so. What our finding implies is that, although farmers are sensitive to price, as would be expected, they would prefer cheaper products to more expensive products. The way that price reductions are framed may not really matter. And this has important policy implications, as it implies that potentially more sustainable and less distortionary public policies that aim at reducing the overall cost of the product could actually stimulate demand without all the negative side effects that subsidies typically entail, or the deadweight losses. There are also many alternatives that could stand as potential alternative sources of public policies. Things like increasing investments in seed research and development to develop better drought-tolerant cultivars, investments in building more or more accurate weather stations to collect the weather data needed to form the basis of the weather index, or investing in remote sensing technologies to improve the granularity with which loss assessments can be made, and to do so at a very low cost. Really, there's a great number of different investments that governments could make in an attempt to reduce the cost of the product, even if it's just reducing basis risk and thus reducing the psychological cost. So why does all this matter? Let me draw us back to where we started, which was this discussion of the ex-ante and ex-post effects of droughts. So can a DTWII product like this offset some of these drought effects? I don't yet have results to share from this particular study, but I do have results from a randomized controlled trial that was conducted in northwestern Bangladesh with a similarly structured weather index insurance product. Though in this particular case, it wasn't bundled to a drought-tolerant rice cultivar like we're talking about here. But the results from this other study suggest that perhaps this can. In this other study, which was just recently accepted in Journal of Development Economics, we find that insurance itself yields both ex-ante and ex-post effects that could potentially offset the ex-ante and ex-post drought risk effects. So the ex-ante effects include increased investments in modern agricultural inputs and more intensive rice production during the monsoon season, while also enticing farmers to diversify crop production into non-rice crops that are presumably higher value than rice. During the dry season, the ex-post effects include increased investments in, again, modern inputs, while also increasing rice production along the extensive margin. They're expanding their area of rice production during this drier season, and also attaining higher yields. So the ex-ante effects that arose during the coverage period can be attributed to simple risk mitigation effects, while the ex-post effects that arose during after the coverage period, when the farmers were no longer insured, can be attributed to income effects. Notably, the increase in expenditures over the course of the two seasons was about twice as much as what farmers could have possibly received. If you look at a per unit of insurance basis, the increase in expenditures was roughly double what the maximum insurance payout would have been. So this, even when we abstract from factoring in the probability of droughts occurring, this suggests that viable risk management solutions can have some type of multiplier effect on agricultural investments that can have long-term impacts on farmer productivity and ultimately on their livelihoods. So now I get to offer a few concluding remarks before we take some questions. First and foremost, I think it's really an exciting time to be a researcher working on the field of agricultural insurance. Certainly agricultural insurance has been around for a long time, but historically there have been a number of challenges associated with the successful implementation and diffusion of agricultural insurance. The agricultural research community, of which Berber and I and many others are a part, we've been active in innovating and identifying research-based solutions to agricultural insurance, including the development of index-based insurance programs that can minimize the severity of adverse selection and moral hazard, and the use of cutting-edge remote sensing technologies. Now, while there have been these great contributions from the agricultural research community, we're in no position to rest on our laurels or pat ourselves on the back. There's still continued room for improvement and innovation. The good news is that this research community is well positioned to make continued contributions. There is probably more scope for additional research to better understand what aspects of crop insurance farmers value and to make inframarginal changes around the existing crop insurance programs to better cater those to the needs of farmers, particularly if the existing crop insurance program is a policymaker's pet project that is unlikely to go away. I think there's also great hope, or it seems as though people are holding out a lot of great hope for the use of remote sensing technologies as a way of assessing losses, and particularly the cost savings that could be passed on to farmers and potentially increase the overall utilization of crop insurance. Unfortunately, the current generation of open access or even affordable satellite imagery that could be used for remote sensing indices seems to be still too coarse for plot level loss assessments, and that seems to be something that farmers really value, is a loss assessment as close to their own field as possible. Berber's work, I think, has done a very nice job of demonstrating that technological solutions do exist that can complement remote sensing techniques and circumvent some of these challenges with the coarsity of the RS imagery. Her picture-based insurance product demonstrates that it is certainly possible to engage farmers directly in capturing a stream of smartphone photographs to document crop losses, and to do so in such a way that you can minimize the moral hazard and ensure that they are properly managing their crop throughout the duration of the season. And going forward, I think agricultural researchers will continue to play an important role in evaluating and validating these different types of interventions, due in no small part to their subject matter expertise and ability to provide important ground truthing. I think we also can play an important role by positioning insurance as one of a larger portfolio of risk management tools. Smallholder farmers can protect their livelihoods from agricultural production risk not only through insurance, but also through savings, credit, informal insurance, and risk coping networks, and as some of my research has pointed out, through the utilization of crop smart agricultural technologies and practices like drought-tolerant varieties. And in fact, I think we've demonstrated the viability of bundling insurance with this drought-tolerant cultivar, but I think there are many other forms of climate-smart agriculture that could be fruitfully employed in this type of comprehensive risk management bundle. And beyond just bundling insurance with climate-smart agriculture, it's also possible to bundle insurance with some of these other tools that farmers can use to deal with risk. So for example, many farmers rely on credit to purchase agricultural inputs. But since the lump sum payments needed are generally in excess of their liquid holdings, and in many cases, formal credit institutions don't exist or aren't very well established in many rural areas. Many farmers don't necessarily have the collateral with which to take loans. It's possible that bundling insurance with a credit product could help to relax some of the constraints that might otherwise inhibit farmers from accessing the credit that they need to purchase productive inputs to help ensure a more sustained and sustainable livelihoods for both them and their family. So those are some of the conclusions that I think emerge from the two presentations that we've heard today. I'll hand it back over to my colleagues in Washington to start compiling some questions for Berber and I to address.
Great, thank you very much, Patrick and Berber. We did receive a few questions. I'm going to start off with a couple technical-oriented ones that they had about your different interventions, let's say. So let me start with Berber because there were a few more on the picture-based insurance. So a couple questions around that were, you know, how do you practically implement this with farmers? What instructions are given to them about the area, the angles, etc.? Is training needed? How do you actually roll this out? So that's one. What are the time and costs involved in taking the photos and having them analyzed with the existing mechanism that you have a panel of experts before this machine learning is able to take place? Is the product available for use by others at the moment? I mean, is this something that others could use and test out? So I'll start with those three for Berber, and then Then for Patrick, I'll just give you a couple of questions that you can think about while Berber's answering hers. So there was just a couple more questions about the rice technology, Patrick. The Sabagi Dan variety you mentioned was short duration. So there was a question about, well, how short is it? Is it much more advantageous than existing ones? And what is the average yield, and how does that compare with the other types of varieties they had? So that was the tech. So let's go with those two, and then I'll come back to others. So first,
okay, thank you so much for these questions. The first question, how to practically implement this. There's a small amount of training that is needed, just at the time of enrollment, which would be the moment, the kind of the interaction that an insurance agent has with a farmer, and this can be done in these plenary marketing sessions, for instance. What we're instructing farmers is to take a picture facing north, so away from the sun, because the shades would otherwise come in the picture, and to take a picture, kind of an overview picture, in which the middle is about 15 meters away from where they stand, from the side of the plot. Other than that, there's in the smartphone app, there's a red line indicating where they should align the horizon, and in the smartphone app, we're also planning on bringing in a compass that it reads in the compass from the phone, because all smartphones nowadays have that feature built in. And so in that way, we can build in more and more things to make the process easier. But yeah, there is a little bit of hand-holding needed in the beginning of the season, like when the farmer starts to enroll for the first time. Other than that, in terms of the time and the costs involved, it's fairly limited. It's not so much that we bring the panel of experts all together, but they are on their own time, just signing on the website and reviewing the series of pictures. And one loss assessment takes them maybe about 5 minutes. So it doesn't take too much time. And you could imagine doing this only for farmers who make claims of having crop damage, so that they only focus on those, and so that will reduce the time burden further. We have calculated the cost of loss assessment to be around $1 per farmer for a policy that would be paying out, having a sum insured of about $100. So the order of magnitude is fairly small, and similar to what you would see, a small percentage of the sum insured, which you would also have when you're using, for instance, weather station data, or when you have to implement seasonal monitoring in order to track the quality of your product. So yeah, the panel of experts is actually, I think the big cost saving is that the agronomists don't need to go into the field anymore to physically inspect what has happened on the sites. And so taking out that step of having to physically go to the field, with that, this approach is really cutting down a lot of the costs. And then the product available, so we are happy to work with people. People can contact me. We have a smartphone application that we're happy to share with people to try out. And happy to think about how to set up the servers that people can start trying this out in their own countries with their own target populations, because that's ultimately the goal of why we are in this. We are delivering a public good, and so we would really encourage people to start using the tools that we have already developed.
Great. Okay, Patrick, over to you about the rice variety. Can you mention a few more aspects of it?
Yeah, sure. So the particular rice variety that we were working with, Sabagi Dan, it takes about 86 days for it to reach 50% flowering, which is about 20 days shorter than Swarna, which is one of the most commonly grown varieties in Eastern India. In terms of yields, during normal conditions or well-irrigated conditions, it yields about 1/10 of a ton less per hectare than Swarna. But as I mentioned before, it's when we get to drought stress conditions that it really starts to show its benefits, and it yields about 50% higher during moderate drought stress conditions and 150% higher than Swarna during severe drought stress conditions.
Good.
Now, I should mention the fact that it has this short duration. As I mentioned during my talk, it allows for farmers to potentially escape droughts that occur at either end of the monsoon season. So if the monsoons are late to arrive, then delaying the sowing of the seed won't necessarily result in reduced yields by the time it comes to December or when it's harvest time. Similarly, if you get the crop in the ground, during the normal time, and you're transplanting when the first monsoon rains arrive in early July, you can harvest early and potentially throw in a short duration crop in between the monsoon season and the dry season to take advantage of some of the residual soil moisture. So there's lots of potential benefits for having this short duration.
Great. So I have a few more questions for both of you. So let me see if I can squeeze them in. So let me continue with you, Patrick, first. So there's a couple questions. A question came in, and I had one as well about your package that you've developed with CSA. So a question that came in was, well, how long did it actually take to develop this new product? So to know, the risk reduction potential of this variety and put it into a viable product that could be sold. And then another question related was, once you have that product, how many subscribers does it take to make it commercially viable or of interest to a firm? So that was one set of questions. And a related one was, I think for the rice variety, it's probably was well tested enough that you could develop a product, and price it properly. But for a lot of other CSA technologies, if you think about conservation agriculture, micro catchments, water, there's a whole variety of them. Do we actually have enough information that you could develop a product around that, around those?
Yeah, no, that's a really good point, Frank, and I think you're absolutely right that we don't necessarily have real good information on the performity of some of these different technologies over different environmental hazards, and certainly I think the variation in performance from experimental stations to farmer fields also throws a bit of a curveball at us when we would think about how to apply a bundling approach to those kind of technologies. I'll just say that I think it's possible, but there I think is a need for additional research to really figure out how to appropriately leverage the complementarity of these two features. Now, when it comes to how long it takes to develop a product like this, I mean, I started doing research on these drought-tolerant varieties back in 2013, and over the course of, say, 2013 to 2015, did some what might be considered like market-oriented research, trying to understand what sorts of demand there was for these drought-tolerant varieties, and then looking at bundling the drought-tolerant variety and a complementary insurance product together. What sorts of effect would that have on the overall demand for this type of product? One of the things that I found in repeated studies, both in India and in Bangladesh, was that farmers could perceive the benefit of packaging these two products together in such a way that there was this complementarity and, in fact, like a multiplier effect on what farmers would be willing to pay for having this comprehensive product. So it did take a decent amount of time to sit down and do the market research. It took a good chunk of time to figure out how to design the insurance product, the insurance portion of the product, so that it was optimized to match the performance profile of the drought-tolerant variety. And I think that's where, going back to my original comment, that's where trying to formalize one of these bundled products with practices like conservation agriculture or like microcatchments, where we don't necessarily know what that performance profile looks like under various environmental stresses, makes those types of bundles more challenging for us to fully develop.
Yeah, good. Great, thanks. Let me now come back to Berber. We have only 2 more minutes officially, but we'll probably take a couple extra just to squeeze in a few of the questions that have just come in. So, Berber, there was a couple questions that came in around the continued use, let's say, the bundling of a weather-based index insurance with the PBI. So, one of the questions that came in was to say, well, would it be better to use a area yield index rather than the weather-based index, given the problems with weather-based index? And then similarly was what is the remaining, since you've shown that the weather-based index use did not really discern farmers who really suffered a loss or not very well, what's the remaining utility of it if you also have picture-based insurance? So those are 2 related ones. And then finally, last one, if I could squeeze in on this, is there was a question about what are the types of farmers that are actually using this and interested. Is it across the board? Are they tend to be more literate, et cetera? Yeah.
Okay. Yeah, those are again great questions. So the reason why we are using a weather index-based insurance product, linking picture-based insurance with that instead of area yield, is that area yield is just very difficult to implement. And so the state government has a whole machinery doing crop cutting experiments in India and also has an area yield index-based insurance scheme. But we cannot access those data on a timely basis. These data are also quite sensitive. Before the data are released even sort of to organizations that are directly working within the crop insurance scheme, there is a lot of discrepancies and sensitivities in these data that need to be resolved. So for us to use these kind of crop cutting experiments that the government is doing anyways, for us it's not feasible because we cannot access those data on time. Actually, in fact, one of the main complaints about the national insurance scheme in India is that the payouts are coming so late because with the crop cutting experiments and disputes between insurers and government on what the final yield estimates are, there is a lot of kind of settlement and disputes that need to be resolved first. So this is why we are using weather index-based insurance, because it is the data is just available almost real time. And so for us, it's possible to do this. Now, of course, it does have its weaknesses, the weather index-based insurance products. And the main reason for why, despite its performance in the first year of the formative evaluation, why we keep using it is that in the first year of the formative evaluation, the product paid out to 20% of farmers, but no, there were not that many farmers that actually suffered severe damage from the weather events that were covered by the product. So in a way, the product made payouts to farmers that shouldn't have received payouts. It might be that we were just in a lucky year and that in 1 or 2 years from now, there's a heat wave and farmers really suffer damage. And the thing about heat waves is that if this affects the wheat during the flowering phase, it affects the grains inside the wheat, but you're not going to be able to see it from the smartphone pictures. And so that's one reason for why we keep using weather index-based insurance, just to make sure that if there is a heat wave, farmers are still covered for non-visible damage. The other reason for using weather index-based insurance is that it offers a way to price the product. So what we have is we look at, okay, based on weather index-based insurance, these are the perils that we want to cover. What would be the cost of the premium in that way? But now instead of, and so that is kind of how the insurance company prices the product using the weather indices. And then the picture-based loss monitoring is used within that product. So it's not a product that is registered separately with the regulators. That would be still a while to go. So it's more picture-based loss monitoring within an existing weather index-based product, and this really helps keeping the product affordable. If it would be a standalone insurance product, there would be separate regulatory processes required. Also, there would be more risk in more ambiguity in how to price a product. So that's why. Then in terms of what types of farmers, is it used across the board or not? We looked at this in the first year, looking at, okay, what are the types of farmers, what are the characteristics of farmers, and who is participating more. What we found is generally there's not a lot of demographic and socioeconomic characteristics that predict participation and take-up. But interesting to note was that we see lower participation among farmers with lower caste in India, and this is what we generally see in a lot of programs, that it's more difficult to get people of lower caste on board. And also, what was it really, and we were worried about the elderly maybe falling out. What we actually noticed was that there was a U-shaped participation. So it was the youth being more likely to participate, it was the elderly being more likely to participate than the people at sort of an intermediate age.
Right.
So that we found really interesting. And what we heard more anecdotally is that it was children helping their older parents, so young children of the farmers helping their older farmers in setting this up. And so, yeah, that's in terms of how participation is.
One last question for you, and then I'll have a couple more for Patrick to wind up. But were you able to estimate how much basis risk you can actually reduce by using the guide?
Yeah, so we have estimates on this. If people are interested, I can share the working paper in which we are doing this. Depends, of course, on the specific metric of basis risk that you're using. But what we found is that about, what was it, for farmers with severe damage, if we would have been using an area yield index-based insurance program, we would have been able to capture around 40–50% of farmers with more than 50% damage. And with this product, we were able to capture 75% of farmers with more than 50% damage. And in the cases where we weren't able to capture that severe damage, it was often related to experts saying, oh, this farmer had severe damage, but it was more due to mismanagement, or we don't see enough pictures in order to establish that there is severe damage.
Great. Patrick, we had just a question, a couple questions on your comparison between year 1 and year 2 results. So you noted in your slide that there was quite a dropout of people who took the product up in year 1 and not in year 2. You did mention that those who had suffered a drought and had received a payout were more likely to resubscribe in year 2. But is the converse also true? Those who didn't experience a drought, were those the ones that dropped out, or in generally, what are the factors behind that group of 33% who did buy the product in the first period and not the second period?
Yeah, so the effect of not receiving a payout during the first year, the point estimate on that effect is negative, but it's not statistically significant. And it seems to be that most of what is really driving the dropouts is the increase in price from year 1 to year 2. So the increase in price reflected not only the increase in expected yield. So we look at sort of a secular trend in yields over time, and we expect as time passes that the average yield should increase, and also the minimum support price also increases over time. So the value at risk is sort of secularly increasing as we move along. So that has an effect on the price of the product. We also increased the administrative premia that we, as researchers, impose to try to move this closer to what might be a commercial commercial rate. Yeah. And so the overall effect led to a pretty, well, I'm not going to say dramatic, but a decent bump in the price from year 1 to year 2, and that seems to be what was really driving people to drop out.
Okay, good, great. Thanks for that further explanation.
Yeah.
Let me thank both of you. I would invite all of you who maybe I didn't quite get to your question, or if you have some more, to just send your questions in. You can find Berber's email address on IFPRI. Is it on the presentation itself? We'll put that on the final presentation that we upload. So feel free to look at that. And I want to thank Berber and Patrick once again for a very interesting and stimulating webinar. And just to announce that our next one is scheduled to be on October 4th on agricultural mechanization in Africa. So stay tuned. Thank you all.